welcome. You're watching The Money Show. I'm with you, Kavita Thaplial, and let's begin the show with a very exciting news. If you're wondering what Indian investors are thinking right now, well, the AMFI numbers answer that without saying a word. Equity inflows have softened to 24,028 crores, down month on month. At the same time, gold ETF inflows have jumped to almost the exact same number, 24,040 crores. Now, the near perfect overlap isn't a coincidence. It's a sentiment shift. That's what is reflecting on the numbers also. Investors aren't abandoning equity, which is why we can see the AUM. It's at a record 81 lakh crore, but they are rebalancing. You can clearly see that in the numbers. Large cap funds are seeing higher inflows, stability over speed. That's the take by the investors. Mid cap and small caps are cooling. Risk appetite is being trimmed. Liquid funds have swung back into strong inflows. Cash is being parked, not deployed. Credit risk and corporate bond funds continue to see outflows. Now, investors want safety here, not yield chasing. And SIPs remain flat at 31,002 crores. Retail investors are staying disciplined, not emotional. So, the message is very simple but very powerful. India isn't fearful. India is cautious. That's right. Gold is being used as a hedge, not a replacement. Equity SIPs are continuing, but lump sum money is waiting for clarity. Now, this is what a maturing investor base looks like, reacting to uncertainty with allocation and not exit. Well, let's elaborate more on this. Let's understand all the nitty-gritties much better. We are joined by Akhil Chaturvedi, who will talk more on this. Akhil, hi, and evening. Welcome to the show. And definitely, this is a headline where gold ETF inflows are almost identical to equity inflows this month. How can we understand this? How can you read between the lines? Is this the clearest signal yet that investors are hedging rather than, exiting risk?
Good evening, Kavita. Nice speaking to you. I think you have summed it up very well. Overall, how the industry is shaped up in the last month. I think what we have seen in the month of January is a lot of volatility in the equity market on the backdrop of especially Indian equity markets, where we have seen a lot of selling by the foreign institution investors, and broadly equity markets gave a negative return. Against that, through the month of January, we have seen almost new highs every other day in gold and silver. I think clearly that is reflecting in the flows. So what I make sense of seeing the numbers is that on the equity side, broadly the flows are sustaining, marginally down. If you look at the net sales, last month, pure equity mutual fund net sales is down from about 30,000 to about 26,500 crores, so about 3,500 crores dip. Largely, we have seen the dip in the flexi cap category, marginal dip in the mid cap and the small cap. Against that, marginally positive sales in the large cap side of the business. Multi-asset funds, which has a element of gold and silver, of course, has gained incremental share by 13%. But broadly, the good news is that the flows in equities continue to remain positive. The SIP flows also sustain at 31,000 crores per month. And even in SIPs, if you see, there are net new investors. The stoppage ratio is actually down from 82% to 73% thereabouts. But yes, the highlight for the month of January is doubling of investments in gold and silver linked ETFs, index funds, which has literally gone up from 11,000 crores to 24,000 crores. That's a clear headline, honestly. What we are also seeing is that given the current global context, investors are diversifying their eggs into multiple baskets. They continue to maintain their equity allocation, and incremental investments is being allocated into gold, silver, and also into liquid funds, ultra short-term funds, which probably will be utilized to move into equities at some point of time. So all in all, I think it's been a decent month, with highlight being gold and silver at 24,000 crores.
Really want you to help our viewers with the kind of expertise you have and with the decades of experience now. I want to understand the move from flexi cap to large cap. See, okay, largely flexi cap are large cap oriented, okay, and they've been doing well even when we've seen continued dips in mid cap and small cap, slight softening. Flexi caps were doing well, but now we are seeing strong large cap inflows, and the cooling continues in mid cap and small cap. Now, what does this actually is signaling? Should our retail investors, reading this as a rebalance strategy? Are they trying to stay the course? They want to be in equity, but then slightly on the safer side, and which is why pure large cap, gives them stability, gives them consistency in the portfolio.
Yeah, absolutely, Kavita. If you see, most investors have become smart. They are aware. They understand valuations and all the chatter and the murmur around mid cap, small cap valuations. And if you see over the last 1 year, mid caps and small caps have also corrected, right? So, given investors' understanding on valuations of mid cap, small cap, and a lot of recommendations through various mediums going for safety net in equity, which is large cap. And that's how the allocation pattern has changed in favor of large cap as compared to mids and smalls, purely on the ground of valuations and what has panned out in terms of absolute returns in the last 12 months. Flexi cap fund is holding up, I would say. It's the largest category. What we have seen, the dip in the flexi cap fund between this month and last month, January over December, is that in December there was a NFO, so that spiked up the flexi cap sales by about 2.5-3 thousand crores. This month there was no NFO in flexi cap, so it has come back to its average run rate over the last couple of months. So net, if you remove the NFO one off, then the numbers are holding up month on month for flexi cap as well. But yes, safety, like you said, safety over returns. I am saying that risk management over return management. Investors have become very smart at this point of time. Clearly, being on managing your risk by staying on blue chip companies, large cap companies. Valuations are fine. Downside protection is reasonably there. I think once the trend changes, I'm sure the reallocation in favor of mids and small also will happen. Uh, uh, I think in very near future.
But then, I also want to understand the reversal story in liquid funds. Lump sums have also shown subdued numbers, but then liquid funds have flipped from outflows to massive inflows. Now, what is this suggesting? Investors are waiting for better entry points in equity?
Yes, absolutely. I think maybe some part of the outflow in equity is moved into liquid, so it would be switch out from equity and switch into liquid or ultra short term funds, and at the appropriate time, money will come back into equities. Also, what we have seen, I have also seen in our fund house where a lot of lump sum money is coming into liquid with a STP mandate. So a lot of money which has come in liquid in the previous month of January would have been registered for STP to be moved into equity over the next 12 months. So it's a combination of some profit booking which would have happened in equity, switched out into liquid, fresh money coming into liquid with a STP mandate, or just simply lying as cash in liquid funds to be switched into equity at appropriate time when the comfort is very, very high. And that's what is reflecting in this massive inflow into liquid funds.
What do you have to say about the sectoral and thematic number? Is that due to the NFOs?
Yeah, I think broadly it's because of NFO. The numbers are what I've seen. The numbers are largely flattish, but thematics are these are very seasonal products. Typically these products get into action when there is a lot of momentum, positive momentum in the market. You will see spike in sales in the thematic category. You've seen that in the last 2 years as well. Largely it is flat for now. I think for now, the flavor will be flexi caps and large caps, multi-asset funds. Let's see what happens to gold and silver this month. Like I told you,
Right.
that I feel that with the correction in silver and the gold prices,
Okay.
maybe Feb numbers might come down, and possibly, and I would hope so that these monies actually come back to equities in the month of Feb.
All right, definitely. You're an equity guy. You want the money back to equity, but then yes,
Yes, yes.
diversification a very important aspect of the entire portfolio. And
Yeah.
over there, hybrids and multi-asset totally and clearly are just taking away the entire spotlight. But I just want to shift the focus on the steady SIP number. Now, what would be the reason behind that, despite so much of market volatility?
Yeah, so I mean, largely the good news is that the SIP numbers have not gone down. They have just held up. I think it's marginally up by a few crores or so. I think the interesting number what I've seen is that we have seen 75 lakh new registrations or new investors coming into SIP, and I think about 50 or 55 odd lakh SIPs have got stopped. So net net we have seen uh, about 22% more number of investors coming through the SIP mode. So equities clearly over the last few months, the all the allocations incrementally are coming through SIPs and STPs. I'm just little surprised that when the number of investors are actually higher, why the amount has not gone up by few hundred crores and why it is flattish. Maybe we'll have to dig deeper to understand that. But good news is it is holding up at 31,000. We are not seeing stoppages,
Yeah.
despite most investors might be witnessing a negative return in last 12-month SIPs.
Absolutely. That's the important point, and that period is a very painful period for an investors to, stay on with their investments, and despite that, maybe just keep on your SIPs going. So hats off and salute to all the SIP investors. But having said that, Akhil, you've been in the business in so long, you go out on the field, talk to so many investors, you talk to so many distributors. I just want to understand what's the lay of the land kind of right now, because we're also looking at a lot of money coming in from tier 2, tier 3. Is your fund house really experiencing that share of your inflows, house inflows going up?
Yeah, so definitely, I think the tier two, three, four or let's say the B30 locations certainly are contributing meaningfully now for the industry as well as for our AMC as well. The mix is actually changing in a very healthy way from 15-20% to more like 35-40% now. I think the kind of activities which are going on the tier three, on the tier two cities, in terms of the rise in number of distributors. Also, we are seeing actually in the tier two, tier three cities, a lot of investor awareness programs are going on, and these are the markets where equity penetration or mutual fund penetration has been very very low. So on a lower base, obviously you will see higher exposure, higher share of growth from the newer markets, newer emerging markets, than the mature markets like Bombay, Delhi, Bangalore, so on and so forth.
Right. One last question, and then we'll wrap up this discussion, because since you are there on the show, I really want some, taking away advice from you for a long-term investor watching this data today. What is that one mistake they should avoid right now?
I would certainly advise that continue to maintain your asset allocation, whatever you decided. If you decided, let's say 50% to equity, hold it up. Do not go lopsided uh, by recency bias, or how the returns have shaped up in the last 12 months. What I'm seeing on the ground is little bit of concern, little bit of anxiety, little bit of curiosity on why Indian equities are not giving decent returns. Uh, I think to a large extent the patience is getting tested. I would say that when you're looking at equity allocations, these are the best times to buy equities when the markets are low, valuations are down, and obviously it will reflect in your last 12-month kind of performance. Just stay the course, maintain your asset allocation, focus on your goals, focus on long term, and please do not move out of equities just because last 12 months have not been great.
So patience, discipline, that's the mantra that you should be applying to your financial portfolio, and very similar to life, I would say that. But in any case, that's the time up on the segment today. Thank you so much, Akhil, for taking your time out and helping our
Thank you.
viewers strategize and especially decoding these AMFI numbers. Thank you so much. And with
Thank
that,
you.
guys, it's it's a time for a short break, and post that we'll do your financial portfolio queries live session with our experts. So stay tuned.